I found 3 stocks that could be undervalued in 2026. Right now, some of the biggest companies in the stock market are getting crushed, down 30%, 40%, and even 50%. And the reason everyone keeps repeating, AI is going to replace them. So people are selling fast. But here's the part that doesn't make sense. These companies are still growing, still making billions, and still used by millions. So why are they collapsing? Is this the beginning of the end? Or something else entirely? So most investors stop at the headline. AI is coming. Sell everything. But that's not investing. That's reacting. The real question is, has the business actually broken? Or just the story around it? And that's where things get interesting. Stock number 1 is Intuit Inc. You already know about this company. It does TurboTax, QuickBooks. So if you run a business, chances are you have probably used it. Now here's the fear. AI will replace the accounting software. So why use QuickBooks? If AI can do it instantly, it sounds pretty convincing, right? You don't have to worry about doing everything by yourself. That's why the stock has almost dropped 50%. But here's what people miss. The business isn't just the software, it's the infrastructure. Millions of businesses, they do 3 things. 1, store data, they manage their taxes, and also run operations. Those are the 3 things. And switching away, it's not easy. It's not as easy as downloading a new app and switching over. It's migrating years of financial data, retain terms, retain teams, and risk errors. And that friction matters when a business is on that scale. So let's talk about the numbers side. It's still generating strong cash flows, still profitable, and still growing. It's just a bit slower now. The big change isn't the business. It's what people are willing to pay for it. So it went from high growth tech company to maybe AI kills it. That shift alone can cut a stock in half. And that's where everything is. So now let's jump on to stock number 2, which is Salesforce. Now this one is even bigger. Every time a company tracks customers, runs sales pipelines, sending marketing emails, and there's a good chance Salesforce is behind it. It's basically the operating system for a sales team. And yet, the stock is down hard. And here is the core narrative. AI agents will replace sales software. But think about this. Salesforce isn't just a tool. It's an entire ecosystem. So, what companies use it for? They use it to build workflows, do integrations, and customer databases. This is throughout the years. And replacing that, it's going to be pretty difficult. So, let me tell you what is happening with Salesforce. The growth is slowed down from almost 15% down to 10%. It's still profitable. And guess what? It is still dominant. But in the market, slow growth is the problem. So fear plus slowdown, it just basically equates to a sell-off. So even if the business is still solid, well, there are still fears. Now here's stock number 3, which is ServiceNow. Now this one is the least talked about. You don't use it, I don't use it, but massive organizations do. Organizations such as hospitals, banks, governments. It runs their internal systems. So basically it does 3 important things: IT requests, HR workflows, and internal operations. This is a deeply embedded software, and this is the key. Once a company installs this, it's locked in. And if anyone thinks about switching away, it's extremely painful, it's super expensive, and super risky because we're talking about internal documents and data. That's called a high switching cost. So why is it falling? It's the same fear again. AI will replace it. But now think deeper. Will AI really replace it or integrate into it? Now here's the difference, which is the delayed payoff. Now step back and look at all the 3. Different companies, different products, and different customers. And all of them have the same problem: AI fear, slowing growth, and collapsing sentiment. And that's the key word, sentiment. And here's what most people never understand. The market doesn't just price reality, it prices expectations, the future. And right now, expectations are collapsing faster than businesses. And that creates a gap. If the fear is correct, the stocks go lower. But if the fear is overblown, that's where the opportunity comes from. Let's get a reality check. I mean, this is not easy because when everything looks bad, buying feels wrong. And that's where most people miss it. Or maybe you're just grabbing a falling knife. So you got to make sure that you do your due diligence for all these three stocks. I'm not a financial advisor, so you got to do your own due diligence and consult your financial advisor. So now you got to understand the game. It's not about the hype, it's about the headlines. It's about finding the gap between perception and reality. And here's the part that most people get stuck on. Knowing this is just one thing. Actually acting on it, it is another. So the real question becomes, where should you actually put your money right now? That's exactly what I'm doing on financewithbera.com. I'm not just talking about stocks, I'm showing my portfolio, where I am investing and how I'm thinking about these opportunities. So instead of guessing, you can see how this plays out in real time. Because at the end of the day, understanding this market is one step. Building a portfolio is what actually makes money. So if you enjoyed this video, do check out this video on the screen right now.